This is Saturday, February 21st, 2026. In the last 72 hours, silver just collapsed from $31.80 an ounce all the way down to $28.44. That is $3.36 per ounce gone in a matter of hours. Billions of dollars in paper value evaporated. And the reason they are giving you on the financial news channels is that U.S.-Iran diplomatic talks have resumed, geopolitical tension is easing, and safe haven demand is dying. That is the story. That is what they want you to believe. If you are watching this right now and you are panicking, I need you to stop, take a breath, and watch this entire video because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. And by the end of this video, you will understand exactly what it is. Here is what is actually happening right now. Silver paper contracts on the COMEX dropped 10.6% in 3 trading sessions. At the same time, the U.S. Mint has suspended sales of the 2026 American Silver Eagle for the 3rd time this year. Let me say that again so it sinks in. The paper price of silver is crashing, and you cannot buy the government's own silver coin. The Perth Mint in Australia issued a notice on February 18, 2026, stating that retail premiums on 1-ounce silver rounds have been raised to 22% over spot. 22%. Meanwhile, the Shanghai Futures Exchange reported a 34% drawdown in registered silver warehouse stocks in the last 30 days. The price is crashing, but you cannot buy the product. Does that make sense to you? Does that sound like a real market? Something is very wrong, and by the end of this video, you will understand exactly what it is. Welcome. If you are new here, this channel is dedicated to cutting through the noise and showing you what the data actually says about precious metals markets. If that is the kind of analysis you are looking for, hit subscribe and turn on notifications because this is the kind of analysis you will not find anywhere else. A few weeks ago, I made a video on this channel. In that video, I told you that silver was sitting at a critical technical level near $30, that lease rates were beginning to spike, and that institutional positioning on the COMEX was shifting in a way that historically precedes sharp, volatile moves. I told you a big move was coming, and it came. But here is what I did not expect. I did not expect the U.S.-Iran diplomatic narrative to be the trigger they used to flush the market. I did not expect the U.S. Mint to go silent on Silver Eagle sales at the exact same moment the paper price dropped. I did not expect Shanghai warehouse drawdowns to accelerate while Western paper prices collapsed simultaneously. And I did not expect the 90-day silver lease rate to jump to 4.7% on February 19th, the highest reading since the GameStop silver squeeze attempt of early 2021. And that is exactly what we need to talk about. Let me explain how the silver market works, because most people do not understand this, and that misunderstanding is costing them money. There are essentially 2 silver markets operating at the same time, and they could not be more different from each other. The first market is the paper market, the COMEX in New York, futures contracts, ETF shares, options, derivatives. In this market, for every 1 ounce of physical silver that exists in a deliverable vault, there are somewhere between 300 and 400 paper ounces trading hands every single day. Here's what you need to understand. The paper market does not require silver to exist. It requires contracts, margin accounts, and confidence. The paper market is like a giant poker game where everyone at the table has chips, but only a handful of players actually have the cash to back them up. As long as nobody asks to cash out at the same time, the game keeps going. The second market is the physical market, the actual metal. Mints, refiners, dealers, industrial buyers, central banks. This market runs on supply and demand of a real, finite, tangible commodity. And right now, these 2 markets are telling 2 completely different stories. One says silver is worth $28.44 and falling. The other says you will pay $34 or more if you actually want to hold it in your hand today. Pay very close attention to what I am about to show you, because this is where it gets very interesting. On February 17, 2026, the Royal Canadian Mint quietly updated its wholesale pricing sheet, raising the dealer premium on 100-ounce silver bars to 18.5% over the COMEX spot price. Let that sink in. One of the most respected sovereign mints on the planet is charging nearly 19% above the, quote, market price for silver. If the market price were real, why would they need to charge 19% above it? On that same day, February 17th, SD Bullion, one of the largest online silver retailers in the United States, showed a 10-day delay on all new silver orders. 10 days. That is not a shipping delay. That is an inventory problem. On February 19th, 2026, the CME Group, the parent company of the COMEX, quietly raised margin requirements on silver futures contracts by 12%. Let me say that again so it sinks in. The same exchange, where the paper price is being pushed down, raised the cost of holding silver contracts by 12% on the same day the price was crashing. They raised the cost of holding your position while simultaneously hammering the price lower. Does that make sense to you? That is a forced liquidation mechanism. That is not a free market. That is a managed exit. But it gets worse. HSBC's London Vault, one of only 5 LBMA-approved silver vaults in the entire world, reported a 19% reduction in registered silver holdings between January 31st and February 14th, 2026. 19% in 2 weeks. JPMorgan Chase, which holds the largest single silver vault position of any institution on the planet, increased its house account silver position by 11 million ounces between February 1st and February 20th. Let that sink in. While the paper price crashes and retail investors panic sell their ETF shares, JPMorgan is buying 11 million physical ounces. One side is selling paper, the other side is buying metal. One side is playing a video game, the other side is taking home the prize. And this is not new. This has been the pattern for as long as I can remember. Now let me tell you who is doing the selling and who is doing the buying, because this is perhaps the most important part of this entire video. American institutional players, the large bullion banks, the COMEX registered dealers, the ETF authorized participants, are the ones flooding the paper market with sell contracts. They are driving the price down on screens. Meanwhile, entities in China, India, and the Middle East are the ones placing physical delivery orders. On the Shanghai Gold Exchange, physical silver withdrawals hit 1,200 metric tons in the first 19 days of February 2026 alone. In India, silver imports for January 2026 came in at 4,800 metric tons, 62% above the 5-year average for that month. In the United Arab Emirates, 3 separate sovereign wealth funds filed delivery notices on COMEX silver contracts totaling 8.4 million ounces between February 10th and February 20th. American institutions are selling paper silver into a falling price. Eastern sovereign institutions are demanding physical delivery. One side is accumulating a scarce real asset. The other side is collecting depreciating paper receipts. That is not coincidence. That is a coordinated wealth transfer. Let me show you the technical indicators because the data at the margin level confirms everything I just told you. The 90-day silver lease rate, which I mentioned earlier, hit 4.7% on February 19th. To put that in context, in a normal, well-supplied silver market, the lease rate sits between 0.1% and 0.5%. When it spikes above 2%, it means institutions are desperately borrowing physical silver to cover short positions. When it spikes above 4%, it means the system is under serious stress. 4.7% is a panic signal. The last time lease rates were this elevated was March 2020 during the COVID liquidity crisis, and before that, early 2021 during the Reddit silver squeeze. Both times, the paper price was suppressed while the physical market was screaming, and both times, within 60 to 90 days, the paper price violently repriced higher to reflect physical reality. The COMEX registered silver inventory, the metal actually available for delivery, now stands at 148 million ounces as of February 20th, 2026. That sounds like a lot, but open interest on silver futures represents over 47 billion ounces of paper silver. The ratio of paper to physical deliverable metal is now above 317 to 1. 317 paper ounces for every 1 real ounce. That is a panic signal. That is a system at its limit. Let me connect all of this together for you. What we are witnessing right now is not a silver bear market. It is not the market deciding that silver is worth less because Iran and America are talking. What we are witnessing is a deliberate, institutional-level suppression of the paper price during a period of acute physical shortage, executed at the exact moment a geopolitical narrative provides convenient cover. The paper price drops 10.6%, and the financial media says safe haven demand is falling. The physical market simultaneously shows a 22% premium in Australia, an 18.5% premium in Canada, 0 U.S. Mint inventory, a 34% Shanghai warehouse drawdown, 4.7% lease rates, and 11 million ounces of JPMorgan buying. One of these things is a lie, and it is not the physical market. Now let me tell you what this means for you, and I am going to be very direct here, no sugarcoating. If you are holding paper silver, ETF shares, futures contracts, certificates, you need to understand that what you own is a claim on a system that is running at 317 to 1 leverage. You are holding a poker chip, not silver. You are 1 margin call, 1 institutional exit, one force majeure notice away from discovering that your paper claim cannot be honored in metal. If you are holding physical silver, coins, bars, rounds in your own possession, do not let a crashing paper price shake you out of a real asset during a supply crisis. The paper price is not the silver price right now. The silver price is what you pay at a mint today. And today that number is between $34 and $36 per ounce, depending on where you shop. If you are looking to buy, this paper price crash is the entry point that the institutions who are buying 11 million physical ounces are exploiting right now. The divergence between paper and physical cannot last indefinitely. When it closes, and it will close violently upward, not downward. Some people will say this is conspiracy theory. To those people I say, look at the evidence. The U.S. Mint suspended Silver Eagle sales. The Perth Mint raised premiums to 22%. The Royal Canadian Mint raised wholesale premiums to 18.5%. HSBC London Vault lost 19% of registered holdings in 2 weeks. Shanghai warehouses dropped 34% in 30 days. India silver imports ran 62% above average. 3 UAE sovereign funds filed delivery notices for 8.4 million ounces. JPMorgan bought 11 million physical ounces. The 90-day lease rate hit 4.7%, a 5-year high. COMEX margin requirements were raised 12% on the same day the price was hammered lower. That is not conspiracy, that is data, that is facts, that is reality. Let me show you the bigger picture, because what is happening today did not start today. Going back to 2020, every single time silver's paper price has been aggressively pushed lower on geopolitical or macroeconomic narratives, the physical market has tightened within 30 to 60 days, and the paper price has violently repriced higher within 60 to 120 days. In August 2020, the paper price was suppressed below $25, while physical premiums ran to 30% above spot. 3 months later, silver was trading above $29. In February 2021, the Reddit squeeze was defeated on paper within days, but physical premiums never normalized for over 8 months, and silver closed that year near $23 before beginning a multi-year structural re-rating. What we are watching now is not a one-off event. It is the latest iteration of a structural problem. A paper market built on 317-to-1 leverage sitting on top of a physical market that is draining faster than it can be replenished. This is not a short-term supply hiccup. This is not geopolitical noise. This is a structural problem playing out in real time. Now let me tell you what I believe happens next. I believe the paper-physical divergence we are seeing right now, with physical silver commanding a 22 to 25% premium over the COMEX paper price, will force a repricing event within the next 60 to 90 days. I am not saying the 2011 silver spike to $49.80 will repeat exactly, but the fundamental dynamic is the same. A paper market that has oversold a commodity it cannot deliver, meeting a physical market that is running dry. The question is not if the paper price reprices to reflect physical reality. The question is when. And based on the lease rate data, the vault drawdown data, and the institutional buying patterns I have shown you today, I believe when is measured in weeks, not months. The breaking point in this kind of system does not come with a warning. It comes with a gap up open on a Sunday night when nobody is watching. Now there are 3 types of people watching this video right now. The first type is scared. They saw the price drop, they panicked, maybe they already sold, and now they're watching this video trying to figure out if they made a terrible mistake. The second type is confused. They can see the price falling, and they can see the physical market tightening, and they cannot reconcile those two things because they've been told their whole lives that price reflects value. The third type understands. They've been watching this market long enough to recognize the pattern. They are not surprised, and they are using this paper price crash as an opportunity. Which type are you? The paper price of silver crashed 10.6% this week. During that same week, the U.S. Mint had no Silver Eagles to sell you. The Perth Mint charged you 22% above the falling paper price. The Royal Canadian Mint charged dealers 18.5% above spot. HSBC lost 19% of its registered vault holdings. Shanghai warehouses drew down 34%. India imported 62% more silver than normal. JPMorgan bought 11 million physical ounces. And the 90-day lease rate hit a 5-year panic high of 4.7%. One of these things is a lie, and it is not the physical evidence. This is what manipulation looks like. This is what a paper market in structural failure looks like, and you get to decide which side of this trade you want to be on. If this video gave you clarity that you could not find anywhere else today, subscribe and hit the notification bell, because the next move in this market is going to happen fast. Drop a comment below. Are you buying this dip in physical or are you waiting? I read every single comment. That is not a market. That is a magic trick. And now you know how the trick works.